systematic S&P 500 strategies targeting stability and growth potential. Advances in volatility control techniques, coupled with the robust and liquid trading ecosystem around the S&P 500, have supported the development of the S&P 500 Futures Intraday Edge Indices. The S&P 500 Futures Intraday Edge Indices are an innovative index family that measure strategies which dynamically adjust exposure to the S&P 500 while seeking to enhance growth potential. The indices use an intraday rebalancing mechanism leveraging three different signals. First, the indices look at two volatility measures: realized volatility, based on historical price changes of the S&P 500, and implied volatility, a forward-looking estimate of future price movements. The second signal assesses intraday trends, and lastly, an overnight signal, which further strengthens the rebalancing approach built into the indices. These features work together to help the indices react to changes in market conditions as they seek to capitalize on trends and optimize S&P 500 exposure while maintaining stability and enhancing growth potential. How do the S&P Futures Intraday Edge Indices work? The indices seek to maintain a target volatility level by dynamically adjusting exposure to the S&P 500. Under the volatility control framework, exposure can increase up to 180% in lower volatility environments as the indices seek higher upside capture potential. In addition, exposures can shift into cash up to 100% during higher volatility periods as the indices seek to reduce potential drawdowns. Complementing this framework, the indices include volatility rotation, intraday trend, and an overnight signal to respond more effectively to market events and capture momentum signals. The exposure can scale up or down based on these features, which helps improve the indices' responsiveness compared to more traditional risk control approaches. Let's take a closer look at how these three features help the indices maintain stability and increase growth potential. Volatility rotation dynamically shifts between realized and implied volatility. This is a key feature of the indices' edge component. When expected volatility is consistently increasing, the indices use implied volatilities to better reflect forward-looking risk. In periods of stable expected volatility, the indices will only adjust their exposures based on realized or past volatility, prioritizing recent market conditions. This combination enables the indices to adjust exposures more proactively while maintaining their predefined volatility targets. Intraday trend. At multiple points during the trading day, the indices evaluate price movements to estimate the potential strength of market trends. When these movements exceed a predefined threshold, the indices systematically adjust their allocations to align with the direction of the market. This approach is applied in both rising and falling conditions, helping the indices respond dynamically to material intraday movements. Overnight signal. The indices apply an overnight adjustment factor that identifies short-term deviations in market trends and adjusts their allocations accordingly. After a sharp market decline, this mechanism allows the indices to increase S&P 500 exposure, helping them participate in potential rebounds. The end result is a family of dynamic indices that react to changes in market conditions as they seek to capitalize on trends, optimize S&P 500 exposure, maintain stability, and enhance growth potential. To learn more about the S&P 500 Futures Intraday Edge Indices and to get the latest performance data, visit spglobal.com/spdji.